All right, today is Thursday, June 17th. Where did the time go? We were talking about April a few days ago. Now we're already at June 17th. And tomorrow we're going to be dead. Anyways, until then, we got a job to do. And here it is, because the market's reaction today was weird, to say the least, all over the place, doesn't make sense at all. So we have to untangle the web and try to make sense with the information we have. And let's start by reviewing the Fed's decision yesterday. Jerome Powell came out and said that inflation is rising higher than they have expected, and the likelihood is that while inflation is reading at 2% right now, and by the way, 2% according to their formula, which is the bullshit formula. But anyways, Jerome says that by the end of the year, inflation will read a lot higher than it is reading right now, meaning well above 2%. Now remember, the Fed wants to average inflation at 2%. 2% is not a ceiling, so to average to 2%, we had a lot of deflation in the past years, so you gotta read 3%, maybe 3.2, 2.8, who knows? Because the Fed says we're not going to use any formula to figure out what's too hot. We're not going to figure out how to average to 2%. We're just going to eyeball it. Okay, so inflation is going to rise higher than expected. That is an admission from the Federal Reserve, but they say don't worry about it, it's going to be transitory. But until then, it will continue to rise higher. They also say that we're not tapering right now, but we are retiring the term of we're not thinking about thinking about tapering. And now we're going to use for meeting, about talking about tapering. Okay. But the most important revelation from yesterday was that the Fed will raise interest rates sooner than expected. They said 2024, that was bullshit to begin with. Now they say 2023, we know that is bullshit, but it is earlier than 2024. And the dot plots show that the Fed could start raising interest rates as soon as 2022. What does that mean? Remember what Powell says. Tapering will precede raising interest rates, meaning that step number one in the tightening of the monetary policy will be via tapering, and then interest rates will follow through. So if raising interest rates is going to happen sooner than expected, then the natural conclusion is, well, tapering is going to happen sooner than expected. What does that mean? Read the market's reaction. If tapering is going to happen sooner than expected, then yields, treasury yields that is, should go higher. The dollar index should go higher, and the NASDAQ, the high multiple stocks, should go lower. Now, when it comes to commodities and the inflationary stocks, that's debatable, because if the DIX is going to blast higher, the dollar index, then commodities in large will go down. Perhaps we're going to have some exceptions here and there. And if these commodities are going to go down, then the inflationary stocks, specifically related to commodities, the likes of metals and agricultural stocks, will go down. However, since yields are going higher, perhaps financials and regional banks will outperform. And it appeared as if the market is reacting this way yesterday. Matter of fact, I issued a tweet saying that all of what Jerome Powell is saying, double down on banks and the KRE regional banks. Well, you know what happened today. Financials and the KRE regional banks got whacked today. Absolutely whacked. And I cautioned other viewers and responders who said, should I buy calls right now? And I said, watch out, wait, don't do anything at all. Because for all you know, the market could do a 180 right away starting tomorrow. And then it does another 180. And it's going to yo-yo back and forth until it settles in one direction. We have smart investors, the likes of Paul Tudor Johns, who said if the Fed is not going to taper right away, then I'm going all in the inflationary trade. And if he did that, he got whacked today.
Right now, and you are a trader.
Right.
Not necessarily even a long-term investor, but a trader. Let's just say you're thinking about where to put your money. I'd actually love to hear about it in the context of being a trader, but also actually as a long-term investor. What are you supposed to do in this environment?
Well, I'm going to watch the Fed on Wednesday. If they treat these numbers, which were material events, they're very material. If they treat them with nonchalance, then I think it's just a green light to bet heavily on every inflation trade.
So what's going on here? Why is the market responding this way? Because what we got today is the following. Yields did 180, collapsing right away, reversing all of the pop from yesterday. Gold went down further. Commodities got absolutely whacked. Bloodbath in the commodities market. Likewise, the Nasdaq, which was supposed to go down, actually rallied today. We saw the high multiple names leading the market in the action today. However, the dollar index is the only indicator that kept the move from yesterday, popping higher once again. Folks, it's going to be really confusing here. So if you're following the moves of the stock market day by day, you will get slaughtered, because this is a bonds market story, not a stock market story. The bond market will speak first, and the stock market, led by the algos, will react according to the movements in the bond market. Yields going down today, that boosted the Nasdaq and the high multiple names higher. But what is the story behind the story? Number one, we have China cracking down against commodities. This has been going on for a while now. China is the biggest consumer of commodities. If commodities prices rise higher out of whack, that will cost China a lot of money, and therefore China is battling commodities traders and unleashing its own reserves. But we already knew that China is cracking down against commodities. That's not what triggered the move today. You could say, okay, China cracking down on commodities, in addition to the dollar index popping higher in an extreme way, that is a double whammy against commodities. And that explains the bloodbath we saw in the futures market today. And that is one possible explanation. Explanation number two, it could be the technicals. And that's about it. The market is confused. It is not sure whether to believe the transitory argument by the Federal Reserve or the Federal Reserve's own admission that inflation is rising beyond their expectations. What do we believe here? And if we cannot believe one argument or the other, then the market says, all right, I'm just going to follow the technicals. And the technicals say, for example, here is a financial stock and inflationary name, Goldman Sachs, which I happen to own in my portfolio. This has been trading in a straight vertical line since the beginning of the year. Stocks don't trade this way. There's no such thing as to the moon, bro. You gotta stop and correct at some point. This move has been extreme across the inflationary trade, whether we're talking about Goldman Sachs, whether we're talking about Freeport McMoran, whether we're talking about Caterpillar, or even energy names to a certain extent. They have to take a break. We have to see some profit taking in these names, and we're seeing that happen right away. On the opposite side, you have a name like Adobe, for example, which I like a lot, but I don't own in my portfolio. This name has been consolidating since last year, doing nothing at all. So the market could be saying, wait a minute, I'm confused, not sure what to do, but I know one thing. I know how to follow the technicals. And the technicals say, take some profits out of Goldman Sachs and use the money to buy Adobe and Amazon, for example. But what if, and this is the most important point here, what if the market, specifically the bonds market, is starting to realize a very dangerous phenomenon that is taking place in the economy as we speak right now? And this phenomenon is, and I'm going to say it out loud because it is happening, stagflation. Inflation. Remember, yields, when they rise higher, specifically at the longer end of the yield curve, we're talking about the 10, 20, and 30 years. That is an indicator for inflation, but it is also an indicator for the outlook of the economic growth in the future. If we have stagflation, then yes, inflation continues to rise higher, but the future prospects and outlook for the economy is not so good, and therefore yields go down. Do I think that we are in stagflation already? I'm too conservative to make that call. I'm not ready to make that call, but the facts don't lie. For example, the import to export prices rising significantly higher. Is this inflationary or not? It is indeed inflationary. We have the PPI, the Producer Price Index, the highest reading on record. Is this inflationary or not? But while you're having prices surging higher, you're seeing economic activities and the recovery in the jobs market stalling. And that is a classic recipe for stagflation. For example, in the morning, we got the Philly Fed Manufacturing Index. And while the headline number was down, prices paid continued to surge higher. Likewise, you have retail sales down. You have the weekly jobless claims ticking up higher again, signaling a slowdown in the economic recovery. However, prices continue to be at elevated levels. Classic recipe for stagflation. And if the bonds market is realizing this and saying, wait a minute, we're going to start to buy bonds again, and as a result, dropping yields down because the long-term outlook is not so good. Inflation could linger higher, but the economic recovery could stall or even slow down, creating the phenomena of stagflation. I'm not ready to make that call yet because under stagflation, the Nasdaq wouldn't be outperforming. Stagflation is bad for the entire economy. I'm just floating the stagflation thought for you to keep in mind. For now, for all I know, the only reaction that I trust is that of the US dollar, because the US dollar did not yo-yo back and forth. The US dollar maintained the reaction from yesterday. The US dollar is saying tapering will happen sooner than expected, and therefore the value of the US dollar pops higher. In return, commodity prices, specifically metals, get slammed. But I'm not going to read too much in the reaction of the market, yields, the Nasdaq. For now, I'm just watching the show and sticking to my guns. Same portfolio, no new trades, nothing at all. Because chasing this move one way or the other, assuming that you know what the market is thinking, could prove to be fatal. If you bought the KRE yesterday, regional banks, assuming that yields will continue to pop higher because the Federal Reserve Chairman himself said that inflation is rising beyond expectations. And oh, by the way, we're going to raise interest rates sooner than expected. Well, that's good for regional banks, isn't it? Because they depend on higher interest rates. But anyhow, you got whacked today. Likewise, if you choose to believe the move from today, saying, wait a minute, the market is perhaps believing that the inflation will be transitory, or whatever explanation you want to find for yourself. And you go all in the Nasdaq, you go all in bonds. What do you know? Next week we do a 180 once again, and the Nasdaq goes down, yields pop higher, and therefore this is a popcorn period of the stock market. We had a few of those in the last few years. For example, in September, all the way till the elections, that was a popcorn period. And I made that clear to my viewers. We were starting to switch to the IWM and the reopening trade, but not heavily. After the elections, when we knew that Biden won the office, we went all in the IWM, the reopening trade, and the inflationary trade. And that has been an excellent call. Now we have another popcorn period. We have to wait. How will the market decide to untangle the web and pave the way for the next trend for the stock market? And we will follow it either way. If it is indeed go with the Nasdaq, the deflationary trade will do that. If it is stick with the inflationary trade, and the reopening stocks will continue to do that as well. For now, if you're overweight the inflationary trade, commodities, financials, industrials, etc., and you're up big, there is no harm in taking profits. But other than that, I'm not making any moves at all. With that being said, we do have a market to cover, and here we go. The Dow Industrial Average closing in the red, down by 210.22 points, or a decline of 0.62%. The Nasdaq closing in the green, leading the pack by 121.67 points, or a gain of 0.87%. And pay attention here, I know a lot of you skipped this part, but this is where the real juice happens. The Nasdaq closing in the green, leading the market, but watch out for the market breadth, which I'm about to show you in a little bit. But here it is, the S&P 500 closing in the red, down 1.84 points, or a decline of 0.04%. What about the sector's performance today? Leading the pack at number 1 and capturing the gold medal, technology at number 2 for the silver, communication services at number 3 for the bronze, healthcare. Meanwhile, the laggards of the day led by the inflationary trade of materials, energy, financials, and industrials. And here it is, the advance to decline ratio. NYSE at 26% advancing versus 72% declining. A decisive day to the downside. What about the Nasdaq? It should be a good advance to decline ratio, right? Wrong. 40% advancing versus 56% declining. So under the hood, the Nasdaq is not looking so good. And therefore, watch out. Watch out what assumptions you make. I got a lot of messages today. Oh, bro, you see the commodities are dead. The inflationary trade is gone. Go with the Nasdaq, Bitcoin, AMC, whatever garbage you want to float. Be careful. You have no idea what the market will start to do next week as more data starts to hit the wire. Moving on to futures. What a bloodbath today. Jerome Powell is looking at this screen and he's jerking off over and over and over again. There's a shortage in lotion, and that's due to Jerome Powell alone. We have losses of about 2% apiece for crude oil futures, whether we're talking about the WTI or Brent. And then here it is, softs. The biggest whack was for lumber. Lumber violating the 1,000 price point. That was the most important level to keep. And now it is trading well below that number. And you gotta pay attention. If you're not paying attention, you will get whacked. While yields were trading down today, the 10-year Treasury yield, mortgage rates were trading higher. We're seeing home builders pausing their projects. We're seeing home buyers stepping aside, perhaps joining the rental market mania instead. They're waiting for a better opportunity to buy homes. So long as the stock market is trading at all-time highs, the demand for buying homes will never go away. These home buyers are not going to change their minds because prices drop down. If anything, they'll stampede and start buying houses again, reigniting the housing mania. It will never stop because inflation is a monetary phenomenon. So long as the Federal Reserve continues to print money out of thin air, flooding the system with its tsunami of liquidity, over $120 billion of asset purchasing per month, inflation will not go away at all. At all. The aggregate demand is still here, and commodity prices and the likes will recover again until and unless the Fed starts to taper. Now, is the market already assuming that the Fed is going to taper, and this is what merited the reaction of the commodities market today? We'll see. You cannot make that conclusion from one day. The conclusion for now is China is cracking down aggressively on commodities and the US dollar is popping significantly higher. Therefore, commodities are correcting once again. The assumption whether the market is convinced that tapering will happen sooner than expected, you gotta wait for that for a little while. We have one confirmation from the US dollar, but that's about it. We also saw significant pullbacks for cotton, coffee, sugar, OJ, and even coca futures. But the majority of pain happened in the metals side of the futures market. Wow. Gold down, silver down, platinum down, copper down, palladium down significantly by about 12%. I hope you sold that catalytic converter that you stole because now it's down 12%. Here's the question. We have people like Paul Tudor Jones, for example, who said he's going to go all in the inflationary trade if the Federal Reserve doesn't taper. So the question is, will guys like Paul Tudor Jones and the Maverick Wall Street buy the dip in commodities? And by the way, it's funny that I compared myself to him because I only have 0.0000001% of his wealth. But I like to hang out with the big shots once in a while. But anyhow, will he start buying the dip in commodities that we saw today? Will those betting on higher inflation buy the dip or not? Because the US dollar is popping higher in expectations of tapering, but the tapering hasn't happened yet. And there is still room for inflation to ride even hotter before the Fed's hand is forced to taper. What about meats? Even lean hogs, the big tech, did not survive the massacre today, down by about 4%, and we have losses for live and feeder cattle futures as well. What about grains? This is what China cares about, corn and soybeans. They hate to see higher prices for corn and soybeans. Meanwhile, our farmers like to see higher prices on these names. Not too high because that could backfire on their bottom line. But we're seeing massive declines here for corn. You have soybeans and soybean oil down by about 9% in a single day. Again, three possible explanations for the bloodbath we saw today. Number one, the US dollar is popping higher significantly. China, that's number two, China is cracking down on commodities. Number three, and the most important one, because that's the one that's going to stick, has the market already decided that the Fed will taper way in advance? And if that is the case, then commodities will go down because number one, the US dollar will continue to pop higher. And number two, it will also remove the speculation aspect out of the commodities market. I'm too hesitant to say that that is the reason, because if the market is convinced that tapering will happen sooner than expected, then yes, the US dollar will pop higher, crashing commodities. But also, Treasury yields should trade higher along with the US dollar, not down like we saw today. And therefore, I'm saying wait and see what happens yet, because we have a lot of mixed, confusing signals taking place in the market right now. Moving on to the big casino, the options market, and we can get more clues of what the market is thinking by looking at the options market activities. The volume leaders, led by Apple by about 1.8 million contracts, about 70% of those were calls. And here it is, AMC at number 2, with about 1.8 million contracts, about 69% of those were calls. And just to illustrate for you the magnitude of the mania in AMC, the name is trading the same options volume as the biggest stock in the world, Apple. Apple with over $2 trillion valuation, AMC at about $30 billion. This is absolute insanity, but also an illustration to how big this gamma squeeze is. And for now, it is a gamma squeeze. Could it morph into a short squeeze? Yes. But hold your horses or your banana peels, apes, and stick around for the technical analysis because I'm going to go over AMC's chart. I'm going to explain to you that this whole mother of all short squeezes, that narrative is garbage. There is no mother of all short squeezes. And even if every single share shorted gets covered, that will not produce anything close to the rally we saw at AMC already. Anyhow, at number 3, the volume leaders, AMD, with about 1.2 million contracts, about 77% of those were calls. What about the unusual activities in the options market today? Starting with the ticker IWM, the small cap index. And this is a big one. It is a bearish trade buying the 216 puts, expiration date August 20th, with expectations that the name will drop by over 5% by then. They paid about $4 a piece to enter this trade, all in all paying about $9 million. Wow. What about the ticker BPOP? This is for a stock called Popular. It was not so popular today because it was down by about 6% or so. And they're betting for more pain to come here by buying the $70 puts, expiration date July 16th, with expectations that the name will drop by over 6.5% by then, and they paid about $1 a piece to enter this trade, all in all, bringing the total to about $1 million. What about the trade for the ticker ASO? This is for Academy Sports and Outdoors. They're making a bullish bet here by buying the 47 calls, expiration date July 16th, with expectations that the name will rally by over 25% by then. They paid about 80 cents a piece to enter this trade. All in all, bringing the total to about $800,000. What about the trade for the ticker HNST? This is for honest companies, the Jessica Alba thing. They're making a bullish bet here by buying the 17.5 calls, expiration date August 20th, with expectations that the name will rally by over 6% by then. They paid about $1.60 a piece to enter this trade. All in all, bringing the total to about $1 million. Continuing with interesting trades, what about the trade for the ticker UPS? For UPS, they're making a bearish bet here, a big one, by buying the 185 puts, expiration date August 20th, with expectations that the name will rally by the tune of over 7% by then. They paid about $4 a piece to enter this trade. All in all, bringing the total to about $2 million. What about the trade for the ticker COIN? Coinbase. They're making a bullish bet here, perhaps on cryptos in general, by buying the 245 calls, expiration date June 25th, meaning next week. So this is a short-term trade. But they are expecting Coinbase to rally by over 6% by then, and they were willing to pay about $2 a piece to enter this trade. All in all, bringing the total to about $1 million. What about the trade for the ticker CVNA, Carvana? This is a big one. It gotta be an insider because they're buying the 310 calls, expiration date August 20th, with expectations that the name will rally by over 7% by then. They paid about 18 cents. That's nothing. They're paying $18 a piece to enter this trade. All in all, bringing the total to about $7 million. It's $18 per option, but then you're gonna multiply that by 100 to get the value of the contract. Lastly, what about the ticker XOP, the oil and energy ETF? They're making a bearish bet here, a big one, by buying the 88 puts, expiration date July 16th, with expectations that the name will drop by over 6% by then. They paid about $2.45 apiece to enter this trade, all in all, bringing the total to about $900,000. Moving on to the heat map analysis, and let's see what's going on here. Right away, your eyes are drawn to the contrast between red and green. Red is hitting the inflationary side of the market: financials, energy, industrials, materials, and even the reopening names, the value names. Because remember, the market has two roads to follow. One of the inflationary trade, in addition to the reopening and value stocks. The other road is the disinflation of buying the NASDAQ, technology, high multiple, and stay-at-home stocks. This is exactly what you're seeing right now. The market shows one way, at least for now. Financials, energy, industrials, materials down big. The reopening names: cruises, hotels, casinos, airlines also down big. Even within auto manufacturers, when we talk about value names included in that list, General Motors and Ford, these are the value names, underperforming the high multiple names of Tesla, NIO, Xpeng, and Li Auto. Likewise, in the technology sector, you have the big cap, Apple, Microsoft, Google, Facebook, all lighting up green, but you're not seeing the value tech names joining the rally. Whether we're talking about AMAT, Lam Research, Dell, IBM, Cisco, Oracle, all lagging the high multiple, high valuation names within the technology sector. The likes of software, for example, ServiceNow, Snowflake, DocuSign, Trade Desk, Shopify, even within the chip sector of tech, the contrast is clear. You have names like Texas, Micron, Intel. These are the value names within semiconductor stocks. They're underperforming today, some closing in the red. Meanwhile, the high multiple stocks within the chip industry, AMD and Nvidia, leading the performance in the SMH today. What does that say? It says that the market shows one route. Whether that is sustainable or not, that will depend on the follow-up from the bonds market regarding yields, the commodities market, whether the dip will be bought or not, and the US dollar. What about themes? Perhaps we can see a different picture here. Themes, not memes. Starting with the reopening trade, all down with exception of AMC, that's the meme name within the reopening stocks, and then we have Planet Fitness also trading higher in addition to Coca-Cola. What about the inflationary stocks that appreciate under a rising interest rate environment? Not so hot so. We're seeing significant losses here, specifically for names tied to commodities. Freeport-McMoRan and Alcoa down big today, but we're also seeing the reaction of banks to the 180 in the bonds market. The two names I have here, JP Morgan and US Bank, leading the decliners today, along with the commodities tied stocks, Freeport-McMoRan, Alcoa, and Newmount Gold. But you're seeing classic inflationary stocks, the likes of Waste Management, Deere, even Kellogg's, not dropping by much. So that keeps the mystery in the reaction of the inflationary trade today. Is it a one-day wonder, or is there any sustainability in these reactions? What about stocks that appreciate under a declining interest rate environment? And this is an important thought, by the way. These stocks that usually appreciate under a low interest rate environment are outperforming today, as if Jerome Powell said yesterday that he is pushing hiking interest rates further down the road, meaning from 2024 to 2025 or 2026. These stocks are reacting as if that happens. And it didn't. The opposite took place. Jerome Powell said that the Federal Reserve is pushing the outlook for raising interest rates sooner, from 2024 to 2023. Which makes the reaction for these names, specifically the high multiple names, extremely peculiar. Moving on to charts, starting with AMC. This is becoming a pure options play. You look at the options volume, the options open interest, and you know exactly how to trade this name. For now, options traders, while betting on the upside aggressively, for this week at least, expiration tomorrow, the highest open interest and the biggest volume traded was for the 60 to the 65 calls. The 70 is getting some action, but not anything significant. Therefore, I'm seeing a ceiling here for a little while, at least for this week. Likewise, looking at the puts, the majority of puts were traded at the 50 level, meaning that 50 will be a floor at least tomorrow. Whether that's going to hold or not, it depends on market makers. Are they going to buy the stock and keep it for next week, or buy the stock and dump it right away? But for now, I see a range between 50 and 60. Unless we wake up tomorrow and we see more call options buying for 70, 75, that will enable the stock to ride a little higher. But the point to illustrate here is the following. I was watching CNBC in the afternoon today. They had two traders. They call them retail traders, the representation of retail traders. And that is an insult, by the way, to us, real retail traders. These people were in their diapers before I started trading as a retail trader. They joined the market last year. All of a sudden, they're representing retail traders. Give me a break. There are a lot of us who've been trading the market for years and years and years, and we're very responsible. We're not gambling. We're not idiots. We don't just chase meme stocks. We work hard and we take a portion, a significant one, of our income every month and contribute that into creating a solid stock portfolio. And we use some money to trade stocks here and there, options here and there, based on proven patterns in science. So it is a little offensive for me when they bring these two morons, put them on TV and say, oh, these are retail traders, the leaders of retail traders. Give me a break. There's no retail traders here. These are not investors, not traders, not even gamblers. These are brain-dead zombies hooked up on meth looking for the next score. That's all there is. But two of them were parroting each other, word by word. And that tells me that perhaps these two are pumpers. They're in it together. They're buying call options. They're not really investing in the stock, but they're pumping on their social media other retail traders to buy the stock. And their thesis is, oh, the mother of all short squeezes is about to happen. What a colossal of stupidity. Here is AMC. The short floated is about 20%. That's it. 20% of the float is shorted. The float is about 500 million shares. 20% of that is 100 million shares. Today alone, over 300 million shares of AMC were traded. Today alone. Let's assume that every single short covers by tomorrow. 100 million shares bought wide at once at the price of $60. That will increase the market valuation of the stock by about $6 billion. The stock is trading at a valuation of about $30 billion right now. Let's add another $6 billion to $30 billion, and the stock price will move to about $75. That's it, folks. That's it. And this is the so-called mother of all short squeezes. Give me a break. You want to push this stock higher? That's okay, but be honest, because pushing the stock higher will require retail investors to continue to buy the stock and to continue to buy call options non-stop. You can't go all in, say diamond hands, and not contribute every week and every month. If you're all in and you got no more money to play with, and every other ape is doing the same, this will end extremely badly. But if all of you guys, retail traders who are buying AMC, continue to pour more and more money of your paycheck every week, every month, buying AMC shares, then that will keep the stock going higher and higher and higher. And your hope is that perhaps if you go to 100 and beyond, that will freak out the shorts and they will start covering at 100 instead of 60. And if that happens and every short covers, then the stock will add $10 billion to the valuation instead of 6. Therefore, you gotta keep pushing this price higher and higher and higher on your own, and then the shorts will cover at a higher price. But even if they do, it's only 20%, folks. It's only 20%. There is no such thing as the mother of all squeezes by only 2%. You want to see the mother of all short squeezes? Look for a stock with 100% or more of the float shorted. Moving on to the SPY 30 minutes chart. We're still trading within range. The resistance is 423 and the support is 420. Nothing happened here. Still trading within the range. But closing where? Is the chart closing closer to 423 or closer to 420? The answer is closer to 423. And so far, that puts the chart at the possibility of breaking 423 before breaking 420. If the chart closes the week within range but closer to 420, then the possibility is that 420, the level of support, will be broken. And that is a bearish signal. What about the futures contract? 30 minutes chart. And by the way, somebody made a comment, I believe yesterday, talking about the futures market and the technicalities, how inaccurate my analysis is to the futures chart because contracts are being updated, etc., etc. I'm covering the futures chart for illustrations only, meaning I'm using the futures chart to support my analysis of the SPY's chart. If you are trading futures, these numbers will be inaccurate for you. You're going to have to look at the specific contract that you're trading right now. However, I use the chart of the current contract to support my analysis for the SPY because there are certain things they cannot see in the SPY's chart, but you can spot on easily in the futures chart. For example, looking at the 30 minutes, the SPY is consolidating within range, but the futures chart has already recaptured the line in the sand of 4,212.5. Now, closing the week below that level will confirm the bearish reversal. Yet, closing above that level for the contract will be a bullish signal. You might not be able to close the week outside of the range for the SPY. But here you have another chart, the futures chart with specific numbers that you have here. You're not going to trade these numbers, but you know that closing above or below a certain number can help you trade the SPY's chart. For example, reversing tomorrow and closing the week below 4,212.5, that will be a bearish signal for me, and it will help me decide where the break for the consolidation in the SPY happened. In this case, the SPY will break the support of 420 first, even if the SPY closes within the range for the week. Anyways, I think I went too deep here, and that will confuse a lot of people. So moving on to the NASDAQ 30 minutes chart, the Qs. Trading above 344.5. Is this bearish or bullish? It is bullish. Trading around all-time highs, recapturing the resistance level, now support of 344.5. The bulls have the advantage. What about the daily chart for the contract? And once again, the number doesn't matter. The number will differ from contract to contract, but it will help us trade the QQQ. The majority of retail traders are not trading futures. They're trading the SPY and the triple Qs. In this case, we have the chart closing above 14,000, which was a very important level of resistance. The chart consolidated around that number for a few days, and now it is blasting higher once again. The momentum indicator still positive, and that is bullish. Moving on to the IWM, small caps. We had a descending line, and it looked yesterday as if the chart started to crack above this descending line of resistance. We had sort of a triple bottom. It was a good bullish signal, and therefore it makes it a bull trap because it peaks above the line, closing above it, and it has a solid triple bottoming formation. And then what do you know? It slides right back. It starts to break the triple bottom. That's when you know you gotta abandon the bullish bet. And you saw the flush down right away. However, by the end of the day, we saw an oversold bounce reversal. We had one big red candle, followed by a green candle that covers 80% of the body of the red candle, and then trading higher since that candle. This is a bottoming pattern. But keep in mind, somebody's betting $9 million against the IWM, and they are seeing a lot of pain to come for the IWM. Zooming out to the daily chart of the RUT 2000. Again, the level to keep is 2,264. We're going back to that level, and the weekly closing will be important. Closing below that level for the week, then the bears start to gain the advantage. So perhaps this trader in the options market is seeing something we're not paying attention to, at least for now. Moving on to the Dixie, the chart of the day. Look at that move, going all the way to 92, closing short of that number. For now, 92 should be a solid resistance. And if that is true, the US dollar will start to cool down starting tomorrow. If that happens, perhaps we will see some dip buying in commodities. Speaking of, what about gold? Wow, a massive whack in the head and a flush down all the way to the Fibonacci retracement level of 1770. This is too extreme in a short amount of time, meaning that the likelihood is gold will see an oversold bounce very soon, and it should happen from 1,770. Perhaps the dollar tops at 92, starts to reverse tomorrow, and we see gold also reversing higher, and we'll take it from there. What about yields? Here's another one. What happened here? Reversing 180 and going back all the way to the very important level to keep, 1.5%. This chart will keep the stock market guessing day after day after day. Now, cracking 1.5% and trading lower, now we know what to do in the stock market. Yields go down, we abandon the XLF, we abandon the inflationary trade, and we go back to the NASDAQ. But if the chart is going to continue to trade within range, 1.5% and 1.6%, that will keep the market guessing every single day. What is it going to be? Should we pump the NASDAQ again, or should we pump the inflationary trade, financials, industrials, etc.? Therefore, for now, this guy you're listening to is taking to his guns until I see a definitive move by the bonds market. And here it is, the TLT bond prices. This is a weekly chart. We have a higher high. The chart went all the way very close to the gap, but reversing before closing the gap. It is too early to make a judgment one way or the other. For all we know, the TLT is riding on higher momentum, on a recovering momentum. Look at the MACD and the RSI indicators. They're recovering from a decline that spanned over 1 year. But that recovery is not producing a massive move in bond prices, which is not good, because at some point the RSI on the weekly chart will start to read 50, 60, all the way to 80, but the TLT is probably at 150 or 145. What happens when the momentum runs out? What happens when the RSI starts to read 85 and the TLT is trading on 150? Is that all you got? Because if it is, and that's all you got, we got a problem here. Yields are going to pop higher again. Therefore, you got to watch this chart with a lot of diligence. What about the VIX? We have a declining trend line. The VIX breaks the negative trend, and now it is starting to create a positive trend. Not a strong one, by the way, not a steep recovering trend, but nonetheless, we still have a positive trend under construction for the VIX. If that is broken, then we know we have lower reading for the VIX, and the SPY will reach all-time highs. But if the VIX continue to keep that line, the positive trend line, an inch closer to 20, then you should know right away that we are heading into at least a 3 to 5% correction in the SPY. What about Apple? We talked about Apple being a leading indicator yesterday. While the NASDAQ was down, Apple was pretty much flat, didn't do anything at all. As Apple goes, so will the NASDAQ. This is exactly what happened today. Apple popping higher and the NASDAQ following its footsteps. The chart is trading above 131. That is the most important level to keep. This is bullish. We're seeing more demand on call options for Apple. They're still very cheap right now, but perhaps they're not going to be cheaper in the next few weeks. We're seeing a mini baby gamma squeeze happening in Apple. It's not easy to create a gamma squeeze in the largest stock in the world, but you can do that for a day or two, specifically under low volume. And what about the souffle? What's going on here? No update at all. Trading within range. 629 is the resistance and 545 is the support. Is the chart trading closer to 540 or is it trading closer to 629? The answer is it's trading closer to 629. And therefore, the bulls still have the advantage. We're talking about the bulls who are betting on a breakout from this consolidation range. They're betting that the breakout will happen over 629, not under 540. The chart's trading closer to 629, and therefore the bulls still have the advantage. Lastly, what about tulips? Another consolidation within range for BTC Bitcoin. The support at 30,000, the resistance at 42,000. Is the chart trading closer to 42,000 or closer to 30,000? The answer is it is trading closer to 42,000. That opens the possibility that the breakout out of this consolidation will happen higher, not lower. There you go, laser beams. You happy now? Bitcoin will go higher. Are you satisfied? Okay. Now press the like button and invite your friends and your family to watch this show. And if BTC goes down tomorrow, who cares? Moving on to the conclusion of this video. What do we have on the economic calendar tomorrow? Nothing, which in surface will make it a very boring, low volume kind of day. However, we're looking for the conclusion or the final decision, the market's interpretation of the Fed's decision. Is the market reading it as, okay, inflation is going to ride higher for a little while, therefore let's go back to the inflationary stocks, Alcoa, Freeport, etc. Or is the market concentrating on tapering is going to happen sooner and therefore abandon the inflationary stocks, pump bonds and the dollar index, crashing commodities, however appreciating the financial sector of the market? Or is the market looking at this as, well, Papa Jerome just gave us the permission to party for a little while before he starts to taper? If that is the case, then the Nasdaq should go higher. We have a confirmation of the action today. We see an abandonment, at least in the short term, for the inflationary trade, and we see yields down, cracking below 1.5%. Or here's another one. Is the market about to interpret all of this as stagflation? And we're saying it out loud now. If that is the case, then yields should go down and stocks should go down too. Folks, I know everybody wants to trade right away and make a quick buck. But if you are disciplined, this is the time to grab the popcorn and watch until the market settles and decides how it wants to interpret the Fed's decision. It's important because it will give us a period of time to follow a certain theme in the market from now all the way until the tapering. Anyhow, all of this talk is confusing. We're all over the place. You're drunk, I'm high, and that's the way it is. That's all I got for you tonight, and I will talk to you again tomorrow. Thank you for watching. Good night. If you found the information presented in this video helpful, please subscribe, press the like button, the notification button, and follow me on social media.